Hi, my name is Eji Okeho. I am the module leader for 210 Loan, Financial Reporting and Analysis. In this video, I will cover some revision of key topics that have been covered in weeks 1 through to 6. In week 1, we looked at conceptual framework. In week 2, we considered presentation of financial statements and accounting policies. In week 3, we had a look at non-current assets, borrowing costs, and investment properties. In week 4, we looked at intangible assets, impairment of assets, and in week 5, inventories, provisions, and revenue from contracts with customers. In the final week 6, we looked at leases, financial instruments, and income taxes. Now, let's go back to week 1. Week 1 was very important. This week, we laid the foundation for financial reporting. It was imperative that the foundation be properly laid so that you will understand the basis for financial reporting. We started by looking at the sources of regulations. 3 sources were identified. First is legislation. Of course, this varies from country to country. Every country has their own set of legislations. The second set of regulations is accounting standards. In the UK, we have the ASB, Accounting Standards Board. In the US, FASB, Financial Accounting Standards Board. And of course, we have the International Accounting Standards, which is IASB. Then the third source of regulation is the Stock Exchange Regulations, and this applies only to listed companies. We discussed the concept of Generally Accepted Accounting Principles, or GAAP. This is jurisdiction dependent, so in every jurisdiction, you have a set of accounting principles or policies or rules that govern the preparation and reporting of financial statements in such region. There is no such thing as global GAAP, although there is an international GAAP. The intention of the IASB is to make sure that international GAAP becomes global GAAP. Of course, the IFRS worldwide acceptance is increasing, and all UKs may use IFRS standards when preparing financial statements. That said, I must insist that it is mandatory for UK-listed companies. The composition of the International Accounting Standards can be depicted diagrammatically in the diagram that you have in front of you. The IFRS Foundation is the main body. Underneath the IFRS Foundation, you have the IFRS Advisory Council, the International Accounting Standards Board, and the IFRS Interpretations Committee. The Advisory Council advises the International Accounting Standards Board on standards that are being developed. And of course, the Interpretation Committee are responsible for providing a consensus agreement when new standards have been applied or misapplied, have not been applied correctly, or misapplied, or in areas where there is no standards. International Accounting Standards Board, on the other hand, are responsible for developing, promulgating accounting standards, revising them, and ensuring that they are fit for purpose. That brings me to the concept of the framework. The framework document is the underlying principle, the principles that underlines the preparation of general purpose financial reports. The framework document itself is not a standard, but it does not override standards. So that means whenever there is a conflict between the framework and the standard, then the standard prevails. It has to be said that because most standards are now based on the framework, it is unlikely for there to be such a conflict going forward. In the framework, we have to give attention to the qualitative characteristics of financial statements. And these are divided into fundamental qualitative characteristics which are needed in order for the users of accounts to make informed decisions. And the two fundamental qualitative characteristics are relevance and faithful representation. These were covered in detail during the seminar. Then there are four enhancing qualitative characteristics. These are comparability, verifiability, timeliness, and understandability. Now, normally materiality is important. Any item that is not material will not be considered. Additionally, the cost must be weighed against the benefits of producing qualitative information. Then we look into the pillars of financial reporting. These are the 5 elements of financial reporting. It is important that you learn these elements because everything we do will hinge on your understanding and application of these elements. 3 of the elements are in the statement of financial position, and 1 is in the statement, 2 in the statement of comprehensive income. The elements are mostly asset and liability. And these 2 definitions you must learn because the rest elements are based on these 2 elements. Asset is defined as a present economic resource controlled by an entity as a result of past events. Here the emphasis is on the word controlled. So even if the entity does not legally own the item, so long as they have control over it, then it must be regarded as asset. So what is economic resource? Well, of course, this is a right that has the potential to produce economic benefits. Therefore, a lease agreement, for example, is regarded as an asset from the perspective of the lessee, even though the lessee does not own it legally. So this adopts the substance of a form principle. In other words, the accounting transactions must reflect economic reality, the commercial substance, rather than the legal form, where there is a difference between the 2. Liability, on the other hand, is defined as a present obligation of the entity to transfer an economic resource as a result of past events. Now you will notice that in both the definition of assets and liabilities, there must be something present which results from past events. Because of this, contingent liabilities and contingent assets cannot be recognized because their recognition is dependent upon the occurrence or non-occurrence of one or more future uncertain events. Equity, on the other hand, is basically the difference between assets and liability. So it's the residual interest of the assets of an entity after deducting all of its liabilities. The other 2 elements are in the statement of financial performance or comprehensive income, and that would be gain and loss or expenses. For income or gain is an increase in assets or perhaps a decrease in liability that result in increases in equity, other than those relating to contributions from holders of equity claims. Now, if you look at this definition carefully, you will understand why dividend is not deducted from the profit or loss account, because that relates to distribution to equity holders. And when the equity holders acquire more shares, these are contributions from holders of the equity and therefore cannot be regarded as a gain. Expenses, on the other hand, are decreases in assets or increases in liabilities that result in decreases in equity other than those relating to distributions to holders of equity claims. Therefore, dividend, as I have said earlier, cannot be treated as an expense because they are distributions to holders of equity claims. In week 2, we looked at presentation of financial statements, and we considered the main components of financial statements as per IAS 1. And these are statement of financial position, statement of profit or loss and other comprehensive income, which we can refer to simply as statement of comprehensive income, statement of changes in equity, statement of cash flows, and notes to the accounts. A typical example of a simplified statement of financial position that you would find at this level is herewith presented. You will find that they are broken down between total assets and total equities and liabilities. As for the total assets, we break this down between non-current assets, which are mainly property, plant, and equipment, investment, and intangible assets. Then you have current assets, inventories, trade and other receivables, cash and cash equivalents. And that will give us total asset, which must be equivalent to total equity and total liabilities. Total equity is made up of share capital, the share premium account, retained earnings, revaluation reserve, or any other reserve that the entity may have. The liabilities, again, are broken down between non-current liabilities, current liabilities. You will find that this is required in most of the exercises that you will do. Regarding the statement of comprehensive income, a total comprehensive statement is made which starts with revenue, cost of sales, gross profit. Then you have distribution costs and administrative expenses. Then after that, profit from other operations, any other income, finance income or finance charges to give us a profit before tax. And that means once you have deducted the income tax expense, gives you profit for the year. Then the second section of this statement is other comprehensive income. From your perspective, you only require the revaluation gain to give us total income. The third statement is statement of changes in equity. This is the movements between items in equity during the year. So you would find that you begin with the opening balance, prior year adjustment if any. If any shares are issued or redeemed during the year, the dividends paid, any transfers from one reserve to another, and the total comprehensive income will all be shown here on this statement. We also discuss accounting policies and accounting estimates. Accounting policies are mostly principles or bases or measurement bases that an entity would adopt to implement the accounting standards. It is pertinent that the entity must disclose what accounting policy they use. Oftentimes, the accounting policy will not change because it has to be carefully selected. However, there are two circumstances under which accounting policy may change. Either the change is brought about by a new standard, or perhaps the change results in more relevant information being presented. In any event, when there is a change in accounting policy, that change must be accounted for retrospectively, as if the change has always been there from the beginning. Whereas accounting estimates are basically amounts or patterns in which the policy is applied. A typical example of an estimate would be depreciation method. So basically, we are estimating how best or the pattern in which the asset is used over the useful life. So a straight line or reduced imbalance method would be a typical example of accounting estimates. A change in accounting estimate does not necessitate changing the prior year figures. So such a change will be accounted for prospectively. That concluded our week 2 session during this term.